The retail market is treating the latest SEC appellate court filing as an outdated, desperate legal stall tactic, completely unaware that this specific document signals a massive structural rewrite of the entire digital asset liquidity landscape. You are told this is just a repetitive continuation of a multi-year courtroom turf war that the crypto market has already priced in. That is the consensus illusion. The cold financial proof is that the SEC is intentionally timing this specific appellate escalation to block alternative trading systems from clearing secondary market programmatic volume through traditional bank-backed custody rails. By the time we finish auditing the mechanics of this enforcement pivot today, you will see exactly how this legal escalation is being used as a weapon to deliberately freeze institutional order books before clearinghouse automated systems can deploy cross-border liquidity pools. To understand the depth of this friction, look past the public court docket and audit the central mechanism of the SEC's new appellate challenge, the programmatic sales distinction. The agency is not simply asking the Second Circuit to review old evidence. They are explicitly challenging the legal definition of what constitutes an automated blind transaction on a public order book. If the appellate court limits the legal protections surrounding programmatic, non-custodial sales, it creates a massive structural liability for automated market makers and decentralized liquidity pools operating in the United States. While individual retail traders are focusing on settlement fines, institutional legal teams are looking at the operational compliance risk. This lingering appellate window acts as an automatic regulatory pause button, preventing conservative corporate treasuries from allocating capital into an ecosystem where the underlying transaction model remains subject to a retroactive federal override. The hidden battleground of this escalation sits squarely within the compliance committees of Tier 1 clearing banks. Under international capital standards, a banking institution cannot provide primary market-making liquidity for an asset that is actively involved in unresolved federal litigation regarding its underlying market structure. The SEC knows it does not need to win an absolute courtroom victory to achieve institutional capture. It simply needs to prolong the timeline of legal uncertainty. By dragging the programmatic definition into an extended appellate review, the agency triggers automated compliance freezes across legacy financial institutions. This effectively blocks Wall Street prime brokerages from offering leveraged trading accounts or structured institutional products tied directly to the digital asset ledger, locking the capital gates by default. This is the hidden divergence, leaving the public market completely disoriented by the flat price action. Retail channels are waiting for a sudden, aggressive market rally based on past courtroom victories, while the institutional world is pulling back to audit the structural liability of the appeal. Major asset managers are stalling their deployment because their internal risk underwriting metrics flag any asset under active federal appeal as a high counterparty risk. The SEC's strategy is not about immediate enforcement. It is a calculated structural stalling mechanism designed to exhaust independent liquidity pools and allow heavily regulated legacy entities to finish building their own parallel, compliant transaction networks. The appeal isn't an isolated legal event, it is an intentional liquidity lock. To accurately underwrite the technical impact of this appellate escalation, you have to look at how clearinghouse margin requirements automatically react to ongoing federal litigation. When an asset enters a period of prolonged regulatory appeal, automated clearinghouse systems, like the Depository Trust and Clearing Corporation, reevaluate the asset's systemic risk profile. Under standard risk mitigation rules, any digital asset facing an active legal challenge regarding its programmatic distribution structure is subjected to severe haircut restrictions. This means that if an alternative trading desk or prime broker wants to use that specific asset as collateral to back real-time settlement flows, the clearinghouse demands an extreme margin buffer, often exceeding 100% of the trade value. This massive capital drag destroys the asset's primary efficiency advantage, forcing institutions to keep their capital on legacy rails. This brings us directly to the hidden friction point inside institutional matching engines and liquidity routers. If an automated system routes a multi-million-dollar cross-border transaction through a public ledger that is subject to an ongoing SEC appeal, the clearing banks involved must flag that transaction under heightened suspicious activity criteria. The risk isn't a direct fine from the SEC. The risk is a catastrophic settlement failure if a regulatory agency attempts to impose retroactive compliance restrictions on programmatic addresses. To avoid this, global financial plumbing networks build automated compliance overrides that automatically route institutional volume away from public, litigated ledgers and back into centralized permission networks where the legal liability is fully backstopped by traditional corporate infrastructure. The SEC is explicitly leveraging this clearinghouse friction by focusing their appellate briefs on the mechanics of institutional distribution contracts. They are attempting to establish a legal precedent where any automated programmatic distribution that matches buyers and sellers via an algorithm must be subjected to the exact same reporting mandates as a centralized public equity offering. If this structural definition is upheld, it will force every decentralized exchange and automated market maker to implement heavy corporate governance structures, completely destroying the permissionless velocity of the ledger. Institutional capital desks are not going to risk billions of dollars interacting with liquidity pools that could be deemed legally non compliant by a retroactive appellate ruling next quarter. The market is currently tracing a jagged baseline because the legacy financial plumbing is refusing to move until these specific risk models are fully reset. While retail commentators talk about market manipulation and chart patterns, institutional desk managers are running simulations on clearinghouse capital charges. The cost of maintaining the required collateral buffers under an active SEC appeal makes large-scale settlement utility economically non-viable for corporate treasuries. The programmatic volume is intentionally being held in a state of suspended animation, not because the technology has failed, but because the legal infrastructure has been engineered to make compliance too expensive for independent market participants to sustain. While the public focus remains fixed on the courtroom drama, a highly sophisticated capital migration is taking place behind the closed doors of private asset management firms and multifamily offices. These entities are not selling their positions. Instead, they are shifting their allocation strategies to adapt to this extended period of regulatory friction. Sophisticated wealth managers are quietly unwinding their exposure to public, non-permissioned liquidity pools and transitioning their capital into private tokenized investment vehicles. They are using this period of depressed retail sentiment to build massive off-exchange custody positions, fully insulated from the volatility of the public order books, waiting for the final structural resolution of the appellate timeline. This behavioral shift directly reflects the wealth preservation playbooks of the global financial elite. When a multifamily office manages generational capital, their primary objective is the mitigation of systemic counterparty risk. They view the SEC's appellate escalation not as an absolute barrier to adoption, but as a temporary regulatory filter that will systematically eliminate weak, undercapitalized retail platforms from the market. By keeping the legal pressure elevated, the regulatory apparatus effectively creates an extreme barrier to entry that only the largest, multi-billion-dollar corporate custodians can afford to navigate. Institutional wealth desks are positioning their capital exclusively within these highly protected bank-backed custody nodes, preparing for a market structure where independent, unpermissioned trading is completely outlawed. This strategy creates a major liquidity divergence between the public retail markets and the private institutional rails. While public exchange volume drops to multi-month lows, private over-the-counter desks are processing massive ledger transfers between institutional balance sheets. These large-scale players are intentionally avoiding public order books to prevent triggering a retail price front-running cycle. They are constructing highly complex automated swap arrangements that allow them to accumulate and settle digital asset positions directly inside compliance underwritten vaults. They are completely indifferent to the short-term appellate headlines because they are building infrastructure for a multi-decade timeline where digital ledger technology forms the core foundation of global central bank settlement. This is why the public order books look completely barren, despite massive institutional interest behind the scenes. The institutional desks are not going to deploy their primary market-making algorithms into public exchanges, while the SEC maintains an active appellate challenge against the programmatic sales model. They are waiting for the exact moment when the legal framework is fully locked down and the legacy clearinghouses reset their margin requirements. Until that bridge is completely reinforced with corporate governance, the programmatic volume will remain confined to private, tokenized silos, leaving the retail market to chase empty headlines while the elite finish assembling the real financial infrastructure. To decode the long term structural risk of this regulatory escalation, we must analyze the specific intersection of appellate law and administrative procedure. The retail crowd mistakenly believes that a federal district court ruling settles the matter permanently. In reality, under United States jurisprudence, an appellate court review possesses the unique authority to completely vacate a lower court's market structure definitions, creating an extreme layer of trailing policy liability. If the Second Circuit modifies the legal standard for automated contract execution, every transaction processed during the litigation window could be subjected to retroactive compliance reviews. This trailing liability is an absolute non-starter for corporate compliance boards and institutional legal officers. This legal reality creates an invisible compliance wall that completely neutralizes the speed advantages of digital asset rails. When a multinational corporation moves capital across borders, its legal department must guarantee that the transaction path is entirely free of trailing litigation risks. If the underlying settlement asset is entangled in an active SEC appeal concerning its very registration status, the corporation's internal audit matrix will flag the transaction as a high-risk operational vulnerability. The issue isn't whether the asset works technically, the issue is whether an adverse appellate ruling could retroactively freeze the company's corporate accounts or invalidate their cross-border settlement history. To eliminate this risk, corporate treasuries choose the expensive inefficiency of SWIFT over the litigated speed of the ledger. Furthermore, this legal friction is amplified by the deep structural division between the SEC and the Commodity Futures Trading Commission. The lack of a unified federal statutory framework allows the SEC to use the appellate process to continually contest the CFTC's jurisdiction over digital spot markets. This ongoing regulatory border war creates a fragmented compliance environment where digital asset platforms are forced to navigate conflicting compliance standards simultaneously. A broker-dealer might achieve full registration compliance under CFTC commodity guidelines, while remaining exposed to catastrophic enforcement actions from the SEC for failing to meet legacy equity registration models. This fragmentation ensures that only the most heavily capitalized financial institutions can afford the legal overhead required to operate in the space. This calculated regulatory fragmentation is the ultimate weapon of institutional capture. The SEC is intentionally utilizing the prolonged timeline of the appellate process to starve out independent digital asset companies that lack the capital reserves to sustain multi-year legal battles. By the time the appellate court issues its final ruling, the independent market structure will have been heavily consolidated. The independent platforms will be forced to sell their infrastructure to legacy Wall Street conglomerates or face permanent operational closure. The legal friction is not a failure of the regulatory system. It is a highly coordinated, intentional strategy to ensure that the digital financial architecture of the future is owned and operated exclusively by the legacy banking cartel. The overriding macro conclusion of this breaking regulatory update is that the transition to a tokenized financial system is entirely inevitable, but the pathway is being heavily restricted by state-enforced compliance walls. Traditional retail investors are waiting for an unhedged, decentralized market explosion that bypasses the legacy banking apparatus entirely. But this appellate escalation proves that the federal regulatory state will use every administrative mechanism at its disposal to prevent independent capital from achieving unchecked velocity. They are using the legal system to construct a massive compliance filter, ensuring that when the multi-trillion-dollar institutional settlement volume finally transitions to the ledger, it moves through highly centralized, bank-supervised infrastructure. To insulate your capital from this systemic friction, you must immediately eliminate all retail emotional bias from your operational strategy. Stop expecting immediate news-driven price pumps and stop listening to speculative market commentators who do not understand clearinghouse margin mechanics. The institutional market structure does not run on retail enthusiasm. It runs on automated risk metrics and counterparty underwriting limits. You must train your focus exclusively on tracking the physical plumbing of the network, the development of enterprise grade private ledgers, the implementation of bank level AML monitoring systems, and the structural integration of sovereign backed custody solutions. You survive this transition by aligning your capital with the infrastructure, not the hype. This requires an absolute commitment to holding digital assets that possess unwritten foundational utility within the evolving international banking architecture. Prioritize the specific protocols that are actively being embedded into cross border payment networks and legacy clearing frameworks. The assets that will survive the SEC's appellate filtration process are those engineered from day one to provide absolute settlement velocity, strict regulatory compliance data flows, and maximum collateral efficiency for sovereign entities. If a digital asset cannot pass a rigorous global bank custody risk assessment or an automated FinCEN transaction audit, its long term survival probability within the global financial architecture is mathematically zero. The global monetary architecture is being systematically overhauled, and the regulatory pressure we are witnessing is the final phase of institutional consolidation. The legal uncertainty is not a sign of systemic failure, it is the deliberate clearing of the field to make room for the legacy elite to deploy their capital networks under total corporate surveillance. If you continue to navigate this market using an outdated, speculative retail trading model, your capital will be completely crushed by the machinery of the state. You must adapt your strategy to match the long term structural timelines of institutional wealth management. Audit the underlying plumbing, protect your generational capital, and engineer your portfolio to withstand the ultimate institutional capture.